This is Satya Pradhuman of Cirrus Research, and welcome to this episode of Market Conversation. In this episode, we walk through the outlook for 2025. The title of this call, and taken from the quarterly report, Risk-On Posture to Collide with Valuations as Fed Breaks Promise on Rates in 25. Overall, we frame a pretty bullish outlook. However, we also walk through real caution in terms of a rotational, broader market likelihood. We hope you enjoyed the episode. Thanks for joining us. Overall, we have a favorable outlook for 2025, and it's a little hard to say given the massive run we've seen, not just in 24, but also in 23. In terms of the topics today, there's plenty to cover. Let's see how far we get. Risk-on market further fueled by regulatory relief, Bitcoin and banks on the move. The earnings outlook, fundamentally, it has support. Top line growth continues to rebound. Credit is very easy. That said, the markets are likely to broaden further, which also drives a more valuation-friendly bias. We think that in 25, fewer than expected rate cuts are likely. That adds volatility to the bonds and therefore higher multiple stocks. We also see additional consolidation, the urge to merge, another potential support for the lower cap, broader market call. And then we go into some of the themes, investment themes in terms of the broadening out of AI downstream beneficiaries. And we underscore really our multi-year call that we've had on the industrial. Effectively, I think we are now allowed to call it a super cycle. So in terms of the year being very strong, some very specific numbers, the S&P was up a whopping 23%. That said, what was more dramatic was the massive gap that opened between the S&P, or the largest names, and the rest of the market. The Russell was up a paltry 10%. Now, in most instances, that's not a bad absolute return, but clearly it's always about the neighbor's house. In short, it was an incredibly narrow market, the Mag 7 basket, that's leading the charts, and it was up 74% for 2024. Now, what's wild about this is, unlike the 2000 internet run, smaller tech firms have thus far failed to participate in the AI run and the technology sector. Radically different picture than what we've seen in other massive technology-dominated marketplaces. We do think that that is likely to change. We've already got seeds of change in 24 regarding this broadening of leadership, potentially a more valuation-sensitive run. A few things that caught us off guard as we were reviewing the numbers. Number one, the financial sector, really the dark horse of 24. Let's put some numbers on this. This is shocking. Large cap financial sector was up almost 32%. The smaller cap financial sector was up about 17%. If you drill down a little further, though, it's pretty wild. Large banks up almost 35%. That's comparable to, I think, the tech sector. Smaller banks were up, investment banks were up about 52%. That's right, 5-2. So we've made a case in the past year about a credit expansion cycle. This is done quite well already. In fact, I believe this financial sector bottomed really the middle of 23. And so the question is, what's likely to drive this further? So we'll talk a little bit about it. But I do believe that if you're talking about a broadening and you're talking about value, the financial sector has to participate. So I think we're laying the ground case for the financial sector continuing to work here. I'll get into some of the fundamental arguments behind that. Another area of surprise or not surprise to us, the industrial sector. We're entering effectively the fourth year of performance dominance for the industrial sector. The numbers in the smaller companies universe is has massively outperformed, and also outperformed the smaller technology group. Industrials in the large cap arena gained an impressive 25% for 24. Small cap industrials were up 40%. So at the heart of this, what this is saying is that there is something else going on here, that there are seeds of change. And as much as we're all busy looking at the Mag 7, there's plenty of movement. And I believe this can only accelerate into this year. Another data point about speculative elements, that's also shifting. Bitcoin since the election has gone up over like 30% in just a few short weeks. So this environment, it gets a little tough to sort of pin down because there's still plenty of unknowns here. Policies are about to surface. So in fact, writing this outlook for 25, I'm not sure I've found it a harder period in the last 20 years as we've written outlooks. There are just so many potential changes that might surface in just a few short weeks. That said, though, that I think there's some laws of gravity, fundamentals are at work that allow us to sort of look through some of this. So in terms of, the constructive outlook we've got, what's behind this? Intuitively, if you see a strong year in 23, a powerful year in 24, the investor instinct is to start to shy away, take some profits. And to some degree, that does make sense here. Why? Because we do see some change on the horizon. But before I get into it, let's look at some of the base case scenario. Top line growth, sales growth across the globe. It bottomed over 18 months ago. And it's starting to reaccelerate and stabilize in some cases. Maybe China is probably the exception with the weakest, shallowest growth. In fact, if we look out to earnings expectations, those numbers are now, they've effectively bottomed back in late 23. So in other words, the forward year estimates, the percentage of raised estimates, they just continue to climb. They're in their sort of longer term highs here. Probably not peaking, such as the reopening moment globally. But nonetheless, we've got an earnings backdrop that's quite supportive. Importantly, though, we talk about a credit expansion cycle. What we're witnessing in the last year or 2 years is remarkable. The US high yield spreads are now hitting effectively 30-year lows. Those numbers about 250, 270 basis points above treasuries. What that tells us is that the average firm is able to basically invest in projects because funding is accessible. This is incredibly important. In fact, I believe this is the early stage signal that drives the earnings revisions data. If these numbers are favorable, we can kind of plot out where earnings are going to end up. So moral of the story is that I do think you've got a fairly constructive backdrop here. What is a big deal is what we've seen in the last year, 18 months or so, is the rest of the planet, their credit comparisons have converged to the bullish levels seen in the US. So I do think that we've got more stability, more of a constructive earnings backdrop. And these are the basics behind why you would want to own, risk assets. Importantly, to take this a little bit more micro, we've made a case that the financial sector should be favorable. I think plenty of folks that know this story better than me could argue that the regulatory backdrop is about to get a lot easier for financials. And so when you bring those elements together, when we look at the loan data that we're looking at, it's basically bottomed in the last year. And what we're now seeing is, if you look out to the forecast for the earnings environment, what we've got here is basically 7 out of every 10 estimate changes are being ramped higher. This is at the upper threshold for how the banks can behave. So this is super interesting, constructive in terms of an earnings backdrop, fairly bullish in terms of earnings growth. When you take all of what I just said and you bake it into an asset allocation model, it is still a pro-equity stance. Our asset allocation model takes some of those basic fundamentals in terms of earnings growth and bakes it into a single factor model. And what it says is that basically currently we've got a 66% equity allocation. Over the long haul, this model goes back to the 90s. This model is basically a the long-term allocation is about 49%. So bottom line, I've walked through some of the elements of what could drive growth. I firmly believe that share prices chase earnings. And if you've got earnings growth, you've got credit, these things tend to work together. So what's neat about this model, though, is it has correctly called in the last few years a very bullish backdrop. I think that's super interesting, super constructive for this picture. So given what I'm saying, what could go wrong here? And to some degree, what I think is changing is basically the earnings expectations are now finally starting to soften. While they've recovered nicely, when we think about this question of valuation, what you're looking at is basically the performance of the large cap market, and on the other side is the small cap market. Both of those have moved very nicely in the last few years. But when we look at the earnings forward numbers, they are starting to soften a bit. And so this tells us that to some degree that the expectations are ramped up. And now what happens is, even if the fundamentals are right, given the sharp run we've seen in the last year or two, the valuations are certainly likely to become an issue. The backdrop is interesting because at the end of the day, I believe that the December tape was very instructive. What you've got is a record low unemployment we're facing right now, stronger consumer economic data comparisons. So at the end of the day, this goes back to really the title of the report. What we've got here is effectively, we believe, given the setting, that the Fed is unlikely to basically deliver on the expected four times the cuts in rates here for 25. And I believe this is the stuff that introduces volatility to the market. And so if you look at December, in fact, if you looked at the last 4 months or so, the 10-year has sold off by 100 basis points in this backdrop, a period where the central banks are actually easing. So I think this idea of a bearish steepener has resurfaced. And some of it has resurfaced because you've got the markets that have really started to really run. You've got structurally easy credit and low unemployment rates. So those things, when you bring them together, bullish for economic activity, equity valuations become important again. Importantly, what has also changed are some of the tactical measures. This is brand new. I think our risk appetite readings in the last couple of years have been more than constructive. I think there's one time in, I believe, March, April of this year, where the crowding measure that we look at spiked and went to sort of like a flashing red moment. For the most part, what we're seeing is, in the last couple of years, is a market that was sort of broad-based, evenly keeled. Now, this directly conflicts with the popular quotes of, hey, the Mag 7 has led the market, therefore it's bad. What our crowding model does is it uses a valuation metric, and it says, look, even if the stocks are outperforming, if the earnings are tracking the share price, then what is the problem, right? Effectively, NVIDIA has run the last few years. We're all busy quoting how a single stock can run the market. But if the earnings growth is as strong as it appears, then guess what? It can continue. So what this model has done until this last month or so is that basically the multiple of leadership stocks had remained benign. That is changing. In fact, the long haul, 20, 30 years of data, the leadership basket of stocks can trade between, on a valuation basis, parity and a 60, 70% handle in terms of a premium. Guess what? That number has just spiked to an almost 60% premium. This is really the first time in quite a while we've seen this crowding measure begin to rise. So as we go forward into 25, given the frenetic pace of the tape, this is now beginning to tell me, hey, when this model flashes a red, momentum factors break and valuations work better. That's the sort of conditional returns tested on this model. Part two, guess what? globally, risk appetites had been benign. In the US, what we're now starting to see is risk appetites have recently reaccelerated. So if this is correct, given where it's at, we are not far from that sort of like one standard deviation boundary to where it's going. And so once we enter that phase, we're looking at the forward numbers suggest that once your risk appetite hits that speculative reading, which we're not, but it's moved very rapidly in a few short months. That's really when you go into a lower absolute return, when trending factors break down, and so on. So I think this is these two pieces, when I bring them together, it has allowed us to stay effectively out there, remaining quite bullish. As these readings are now starting to marginally change, this is something that, in terms of managing the portfolio, you've got to really think about. So these were the elements during the last few months where investors got nervous. They started to become a little more defensive. Our models were saying it's okay. It's finally starting to change. All right, so in terms of the broader model, our growth value oscillator has been in a value bias for quite a while. In fact, it's leaned value or overweight value since, let's say, spring of 24. So effectively, it's been wrong. That said, take a look at what's been working. Outside of the Mag 7, financials had a record year, industrials continue to run. Those things, they're kind of value-y. So moral of the story is that we haven't seen a true blue value market, and in fact, I don't think you see that deep cyclical run that folks think about. That said, this idea about valuations mattering, it is definitely front and center. The oscillator remains in a lean value posture. In fact, what else changes here? And what causes us to think about valuations more? Well, the new administration that has surfaced, or actually, if you step back for a second, when we look at across the world, we've gone into, most nations are now going into a me first trade pattern. So I guess it's always been China first, but now we've got Europe first. Within there, probably a Germany first, and clearly potentially moving here to a US first mode. And the list goes on. So one of the points that's surfacing here is that when you get regions and countries beginning to act inwardly, this is effectively inflationary. So this idea about our concerns for the bond market, it remains front and center. Besides the Fed policy, some of these regional reshoring events that have been taking place the last few years, if it starts to now heat up to a more intense level, effectively, these things could become inflationary. There's lots of talk about tariffs. We've laid low on it in the sense that, in order to negotiate, you do need bluster. So what we've done, and I believe in the next few weeks and months, we're actually going to have more of a stronger opinion about where these elements move. But to sort of prepare for that, what the team has done is build out these tariff betas. Effectively, what we're starting to monitor now is take US firms that are selling to markets overseas. We rank order those firms in the US that are selling, let's say, a ton to the UK, and then we measure their performance. What this sort of index could show is that the UK firms, they have started to weaken in the last few weeks. So if you repeat this for places like Japan, Singapore, Mexico, Brazil, we are seeing a fallout in the way those sizable US firms that have the most amount of export or trade relationship with Brazil, Mexico, that's really where we're starting to see a fallout. Now, this is complicated stuff. I don't want to over interpret what I'm seeing, but what I'm saying is that the bigger picture is that globally, and maybe some of this is so much credited to the pandemic, where every nation region started to pull more inwardly to some degree. If we all behave like that, this becomes a very expensive chapter. So we're going to watch this. We're building tools to monitor this, to understand sensitivities. I think this is a big deal. But at the end of the day, this is the stuff that changes the profile of equity leadership in 25. The idea that, yes, we've got constructive AI spend that'll go there. At the same time, if you get a painful bond market, the highest valuation stocks are likely to suffer. So it does tamp down the expected return of equities. A few other elements here that sort of that have surfaced is that between large and small cap, there's this sort of tautology, the idea that when you refer to broader markets, guess what? Whether you like it or not, you're also say small beats large. That's the nature of a broader market. So if more firms participate, the smaller cap indices have a bulk of the firms that are public, because most of those firms, their total market cap do not really add up to what these largest 50 firms in the US that are public. So the idea, though, is that if you do have a broader leadership, if you do have a more of a valuation sensitive market, it is forcing you lower cap as well. A few things here that support this. This is a look at basically valuations of small versus large cap stocks. They're all structured at the lower end. We've never really used discounting of small caps to drive the sort of small versus large call, but it does talk a lot about the elasticity of price movements. In other words, as you see moves back to small cap, they can become more erratic, more dramatic. On top of that, if the world becomes more valuation sensitive due to a tougher bond market, guess what? Lower multiples probably lose less ground. You get another reason for potential outperformance. So you don't have the classic makings of a small cap cycle here, I don't think. That typically surfaces with a blown out sort of credit cycle where spreads are incredibly wide, and that's really where you get a zero to hero moment for the smaller cap stocks. I don't see that. Another surprising data point that surfaced in writing the Outlook report was beta. Higher beta, you expect in a year like 24 that higher beta did well. What was shocking to us was the large cap high beta bin. So if I were to rank all the stocks in the S&P 500, take the top decile or quintile, and then say, what was the average performance? That number was a 43%. So large high beta stocks are up 46%. Repeat that for the small cap index, it was up 3.8%. Radically different world. So the performance gap has opened here, which says that anyone who's paying attention to risk assets, they've already made some significant moves towards the higher beta posture. An important supporting data point here, though, is that when you look at the valuation of large cap high beta, that number is now a massive 5.5 times EV to sales. Let me put that to you in a normalized term. That's 2.5 standard deviations above normal going back over the last decade or so. The smaller cap high beta is selling at a 0.9 Z-score. In other words, below longer term averages. So the massive gap that we're flagging, some of this has been driven by fundamentals, but it also talks about a potential reversal that could be more dramatic because of all of these elements that are set. And I think that's why the December pullback is so significant, that as the 10-year sells off more, it does give us some concern, even though I think you do have the makings of very good fundamentals for earnings and cash flow. It's just that the question is, do you get like the sexy, massively double-digit gain for 25? I think that gets more tamped down depending on where you lie on in terms of the bond market outlook. In terms of, sort of like key themes, one other thing in terms of the smaller firm outlook, the urge to merge has been one of our favorite phrases. The idea, though, is that what we are seeing is that if you do have easier access to credit, the banking business is likely to pick up. Now, what you've seen is this real thirst for AI. You've got lots of companies that have been really formulating and developing quietly in the private space. At some point here, given the sort of lackluster deal flow in the last 2-3 years, we see that surfacing. This is exactly why the smaller investment banks are up over 50% in the last 12 months. We know that business is coming their way. In addition to that, because of the credit spread situation and the valuation gap between small and large, the buyout, the merger activity is also likely to climb because the currency to use equity prices, they're basically telling you that the equity cost of capital is incredibly attractive to use for deal making. In terms of the key investment themes, I wanted to focus on, there's two or three of them that I'm going to summarize briefly, but it starts with NVIDIA. What we've seen is a massive dose of spending from all the key players, from Apple, Google, et cetera, where the amount of AI chips being consumed has been impressive. It's really led NVIDIA to be this massive behemoth of a firm. A really important data point is the top line growth has begun to slow. And this is kind of important here because what it also spells out is this idea of another reason for market broadening. We've talked a lot about the downstream beneficiaries of AI. So we'll talk a little bit about data center, alternate energy, and so on. But at the end of the day, the sort of current leadership that we're seeing, the spending has been phenomenal. And to be quite frank, when you look at the CapEx data, most of those are still very constructive. When we look at the government spending data, if you divide them out between industrials and technology, both are actually moving. The technology spend has actually resurfaced sharply because it was really struggling for about 2-3 years there, and now it's really snapped back a bit. What's interesting is that, as we know, has been incredibly narrow, that the tech spending data, as much as that account has recovered, we also know that there have been few participants. A good way to think about this is look at the difference between Intel and NVIDIA, or look at the difference between large tech and small tech. In other words, the spending remains narrow. I believe one constructive data point out of this that's likely to surface now is that the spending is going to broaden to across the board a bit. Part two is the industrial spending. Like I said, we've been bulls on the industrial sector for a while. We're now, 4 years into an expansion phase of industrial spending accelerating. I think that only gets better here. I'll try to make that case. But one of the interesting ways to think about, can NVIDIA's revenues continue to remain strong and accelerate, or at least be really, really competitive? Well, take a look at their customers' margins. That's probably a great way to understand the checkbook for the oracles of the world. And that's exactly what we've done. When we look at the margins for some of the largest firms, from Apple to Oracle to Meta, all of these firms have spent a bundle, but guess what? Their margins are record high, which tells us that checkbook is still open. So the idea of sort of rethinking NVIDIA's exposure, it's important, because whenever you see this sort of clustering, the investor in you has to sort of say, well, wait a second, am I the only one that's aware of this, or am I the last guy coming into this? But it does seem to me that if their customers' margins are incredibly strong, it does mean that they've got checkbook, which allows the demand to remain in place. And then part two to this is really the broadening aspects of AI. We've published some work recently in terms of the downstream beneficiaries. This list will probably grow as we get into the year, but some very simple proxies that we've structured, like the nuclear build out, alternate energy. It really is about energy with the sort of AI applications, the amount of power that's needed. What we're seeing, in fact, our nuclear basket has outperformed sharply. The data center basket that we've constructed has also started to reaccelerate. So these are things that I think allow us to defend this idea that the market broadens. And in fact, what would be different about 25 is, what if you ended up getting the small cap market, but the small tech sector to become revived. In the full bit of work that we've done, what we've shown is that the data center spend, when you look at some of the forecasts that are out there, those numbers are in the double-digit numbers, 12, 14%. When we looked at our basket, that number was the year-over-year sales growth was really at a paltry 4%. So we think there's plenty of room for this to expand. In fact, the census survey of private construction, that account that the government measures, that number in the last year has jumped by about 43%. So I think that the sort of consensus forecasts that are out there, I think these numbers may actually be soft. And this really justifies why we do see this sort of tech broadening of 25. In fact, when we look at November's numbers, this was stunning. The technology sector for the microcap tech sector was up 15%. In fact, the microcap semis were up over 30%. Moral of the story is that things are stretched so sharply when we look at large versus smaller semis as an example, not just the market, that it's not going to be hard to see some of these other groups benefit, especially if, let's say, you're building a data center. And guess what? Running a data center also takes regular semiconductor chips, not just AI chips. So moral story is that the infrastructure build is underway, and this will really force and broaden out the sort of tech leadership that we've seen to date. And then switching over to the industrial sector, for quite some time now, we've made a case as to the reasoning behind the acceleration in industrial spending. This really started really post the post-pandemic moment, that globally all these regions and countries realized they needed to really shore up their own supply chains, because the global supply chain had really come under severe stress during the pandemic. So maybe that was the initial wave. But then when you think about the attack on Ukraine and how Europe is being forced to restructure its own energy policy overnight, and odds are whatever's going on there is not going to change on a dime, irrespective of what happens in the next few months in Ukraine. The global acceleration for EVs, whether the US slows or not, the global picture is actually quite strong in terms of their demand for materials and so on. Climate effects, whether you're designing to prevent to limit climate effects or just reacting to it, either way, the infrastructure spend is likely to continue to accelerate. And then finally, now with the alternative energy needs or the energy needs due to AI build outs, that just puts another layer upon whether or not we continue to build out the grid and alternate sources of energy, such as nuclear. So we're quite bullish that the super cycle for industrials that we're in is likely to accelerate. And one really curious plot point is that 2 of the 3 or so years of this industrial spending acceleration occurred while globally central banks were tightening. What happens if they begin to lay low? So we think that that's why 25 you end up seeing a real shift. In terms of the raw numbers, just bear in mind, I quoted it earlier, the small cap industrial sector was up almost 40%. Large cap industrial sector was up 24%. It doesn't sound like a lot, but guess what? If you remove just NVIDIA from the tech sector, I believe the industrial sector in large cap land outperformed the tech sector in large cap land. So this industrial story is more real. If any of this resonates, guess what? That creates a value rotation as well. So a lot of these pieces are coming together, whether I talk about financials, whether I talk about CapEx. And then finally, active management. The most painful competitive box we could be in is the large cap growth. Most of our active blends, when I look at small, mid, whether it's the value or growth bin, most of the small mid cap blends, the fundamentals have worked. In other words, valuations may not have been great, but they didn't hurt you as much. But to sort of put a fine point on it, the aggressive growth blend outperformed the sort of fundamentally driven basket by about 30% or so for the past year. That's remarkable. What that's really saying is that if you were spending your time looking at the earnings, thinking about where spending is going, you probably could have done better just paying attention to the trend. Let me put some numbers on this. The large cap business momentum, if I just bought large cap stocks where estimates were getting raised for the year ahead, that basket was up 70%. If I just bought large cap stocks, the top 10% or even the top 20% of stocks with price trends that were strong, that basket was up 65%. So in other words, 24 and 23 for that matter, very unique years. If we're right at all about this broadening, then by definition, fundamentals start to matter. This sort of performance pressure that's being faced by all active managers, but especially large growth, I think this begins to subside a bit moving forward. To bake this all together in terms of the portfolios that we deliver, in terms of making sense of this and planning ahead, and to some degree, this is probably risk management for 25. we are going to be more valuation sensitive. We're going to retain that posture. If I'm running the growth portfolios, we expect the GARP model to outperform the quality growth model. This has occurred already, but we also expect the GARP model to outperform the aggressive growth model for everything I've said. And then on the value side, we do not think you're in a deep value moment, even though the word value has been bandied about. A deep value market requires sort of like a blown out economy, credit spreads, incredibly wide, that's about to rally. That's not the backdrop we're painting. So it is sort of like a relative value, quality value world that we're looking at if I'm in the value blends that we run. To put this all together, we are fairly constructive in 25. We do think the risk on places such as Bitcoin banks, they've got some regulatory relief or air support that's there. I think it's going to be tough to question that, at least in the near term. The earnings backdrop is fairly good. And as a result, it really drives the fundamental bias that we've got. The challenge I think we've got here from a macro standpoint really is the long-term bond. The sell-off that we've seen in the last 3-4 months, about 100 basis points, does it get worse? My bias is that it's likely to. That said, the wild cards that are outstanding in terms of some of the policies to surface, it's going to drive really how much we can shift. So to some degree, that is something that we are just going to be price takers on for at least for the next few month or two. And then to close this all out in terms of themes, this broadening of the marketplace, it's probably just good risk management strategy at this point. Our tacticals are now starting to get closer to a flashing red. So, I would probably take that to heart. And then in terms of fundamentals, the broadening in the CapEx story is likely to happen. The industrial super cycle continues to work. And then really the shocker in all of this is really how new financials behave. We think they continue to run quite strong. They've got momentum. Thanks very much for joining us in this episode of Market Conversation. We hope you have enjoyed it. And as always, look forward to your feedback and questions. Thank you.